Financial. Our mission is simple: to forge stronger portfolios by putting the market's biggest stories under the blowtorch and cutting through the weakness. Today, we're zeroing in on the pharmaceutical giant Merck. Now, they just dropped a Q4 earnings report that on the surface looked pretty good, but the stock, it just went sideways. And you gotta ask why. Well, it's because beneath that shiny exterior, we're seeing some serious tremors in the foundation. We're here to run the stress test, to find out if this company is built from structural steel or if it's just a house of cards waiting for a stiff breeze. Let's get to work.
Right, let's just cut right to it. This is the whole reason we're talking about this stock today. The market is looking at two totally different narratives coming out of Merck, and frankly, it has no idea what to believe. You've got this solid, pretty impressive earnings beat for the quarter that just wrapped up. That's the rearview mirror. But then you look out the windshield at what's coming, and the guidance for 2026 looks like an absolute dumpster fire. So the real question, the one we have to answer, is which story is the real one? Is this just management being conservative, or is the market right to be freaking out? Okay, so let's get into the nitty-gritty, because the numbers here tell the whole conflicting story. On the left, you see the good news. A clean Q4 revenue beat, $16.4 billion. That's more money than Wall Street thought they'd bring in. Nice, right? In a vacuum, you'd say that's a home run. But then your eyes drift over to the right side, and the whole picture just falls apart. The earnings per share guidance, the profit they expect to make for the entire year of 2026, is a measly $5 to $5.15. Let me put that in perspective for you. The street, Wall Street, was looking for something closer to $8 or $9. $5 isn't a miss. It's a catastrophic failure. It's management firing a flare gun into the sky, telling everyone to brace for a really, really rough year.
So, to untangle this mess, we need a game plan. Here's how we're going to run this stress test today. First, we'll keep digging into these conflicting signals. Then, we're going to build the bull case. We'll look at all the pillars holding this company up. After that, well, we're going to do what we do best here at Iron Financial. We're going to take a sledgehammer to it with the bear case and look for every single crack. That leads us to the main event, the pipeline versus the patent cliff. Can they build new stuff faster than the old stuff crumbles? From there, we'll stress test the financials themselves to see if they can even afford this fight. And finally, we'll deliver our verdict. Is Merck a huge opportunity, or is it a trap waiting to snapshot?
All right, let's start by giving the bulls their due. Before we can talk about the cracks, we need to understand the structure we're dealing with. And let's be clear, Merck is an absolute titan, a behemoth. The entire bull argument hinges on the idea that despite this awful guidance for next year, the underlying foundation of the company is forged from solid steel, and it's built to withstand just about anything. So let's examine the core assets, the load-bearing walls that give this company its strength. So everything starts with this number, $8.37 billion. Let that sink in for a second. That is the sales figure for one drug, Keytruda, in one quarter. I mean, that's more than the entire annual revenue of a lot of companies in the S&P 500. This drug isn't just a blockbuster, it's the steel spine holding up the entire corporate body. And look, it's still growing at a respectable 7% a year. While everyone is panicking about 2026, Keytruda is a fortress. It's a cash-printing machine that pays for everything else Merck wants to do. This one drug provides the stability and the capital to weather almost any storm imaginable.
But, of course, you can't build an empire on a single pillar, no matter how massive it is. And this is where the bull case gets really interesting. Look at the other sources of strength. You've got the animal health division, a quiet, steady workhorse turning out $1.5 billion, growing at 8%. This business is totally separate from the drama of human drug patents. It's just solid. And then you've got the new kids on the block, Windrivir and Capvoxave. These are brand new drugs, and they're already on track to bring in over $2 billion combined in their first year. These aren't just little bets. These are the first layers of concrete for the company's next big growth wall.
And this is the proof that management isn't just sitting around fat and happy counting their Keytruda money. No, they are out there on the offensive. They are using their capital like a weapon, going shopping for the future. They went out and bought Sadara for a drug that their own models say could be a $5 billion a year product. They snatched up Verona Pharma for another potential blockbuster. This pipeline isn't just some vague promise. We're talking about more than 20 potential new products that they are actively pushing through trials. They are literally building their next chapter brick by brick right in front of us.
Whoa, hold on a second. Building is great. I love a good construction project. But timing is everything, isn't it? Yeah, these acquisitions look fantastic on a press release. But it feels like they're trying to build a shiny new penthouse on top of a skyscraper while the foundation in the basement is actively flooding. Can they really truly build these new drugs into billion-dollar giants fast enough to replace the billions they know for a fact they're about to lose? This feels like a desperate race against the clock, and that 2026 guidance is the alarm bell screaming that they might be losing that race.
That is a very fair point, and trust me, we are getting to that flooded basement in just a minute. But to wrap up the bull case, just take a look at Wall Street, the professionals, the so-called smart money. Out of almost 30 analysts who cover this stock for a living, 16 of them have a buy rating on it, 12 say hold. But the most critical number on this screen is 0. Not one, not a single analyst is telling their clients to sell this stock. The consensus is clear. The people who are paid to look years down the road, they believe in this construction project. They see the solid foundation, and they're willing to ride out these short-term tremors.
All right, enough about fancy logos and Wall Street opinions. You know, Wall Street can be wrong. In fact, they often are. So now it's my turn. Let's stress test this solid foundation. It's time to grab a magnifying glass, or maybe a sledgehammer, and go looking for the cracks. Because that disastrous 2026 guidance, it didn't just appear out of nowhere. It's the direct result of some very real, very painful pressures that are squeezing this company right now. Let's start with the biggest, ugliest crack of them all. This isn't my opinion, this isn't speculation. This number, negative $2.5 billion, came straight from the mouth of Merck's management team on their earnings call. This is a direct hit to their revenue that they are forecasting for 2026. This isn't a small dent. We're talking about a hit that equals about 4% of their entire annual sales just gone, wiped out in a single year. It's coming from two places: cheap generics eating their lunch and new government rules that are going to hammer their prices. This one number is the smoking gun behind that awful guidance. And that $2.5 billion, that's not a one-time thing. Oh no, it's just the first wave of a massive tsunami we call the patent cliff. What you're looking at here are 3 cash cow drugs: Januvia, Bridgin, Difficid, that have been making them money for years. And now their patent protection is evaporating. That means cheap generic copies are about to flood the market, and that is going to absolutely crush their sales. This is a slow-motion car crash that everyone can see coming. It's a predictable, unstoppable erosion of billions of dollars in profit. The revenue is going away. The only question is how fast.
So on top of the patent cliff, you've got other streams of revenue just drying up and blowing away. And hey, don't take my word for it. This is a direct quote from their own earnings call. Significantly lower sales of Lejavrio. This was their COVID drug. It brought in a ton of money during the pandemic. Well, that party is officially over. Demand has fallen off a cliff. So think about it. You've got the patent expirations punching a hole in one side of the boat and the complete collapse of COVID revenue punching a hole in the other. The pressure is coming from everywhere at once.
Now this is the one that really made my jaw hit the floor. Even the most optimistic bulls did not see this coming. Gardasil, their huge HPV vaccine, a product that was supposed to be a core growth engine, sales dropped 35% in one quarter. Now the company has some excuses about buying patterns in China, but a fall that steep in a flagship product like this, that is a massive red flag. It makes you wonder, is this just a blip, or is there a much bigger problem with demand even in their supposedly safest businesses? This crack runs deep, and it's in a part of the foundation that was supposed to be untouchable.
Okay, so the battle lines have been drawn, and they are crystal clear. You have the bear case, a massive $2.5 billion headwind that we can actually quantify, a patent cliff that's chewing away at their old reliable drugs, and shocking weakness in a core franchise like Gardasil. And then you have the bull case, the absolute dominance of their cash cow Keytruda, and a promising pipeline with over 20 potential new drugs. This brings us right to the heart of the matter, the central conflict that will decide Merck's future. Is the new growth they're building strong enough to overcome the old decay?
And this slide really puts that race against time into perfect focus. Look at the left side. These are the new growth engines. These are the drugs that are supposed to carry Merck into the future. But then look at the right. Those are the anchors. Those are the revenue drags that are actively pulling the company backward. The billions in sales from Januvia and these other drugs, they're going away forever. So the question becomes simple math, but the execution is incredibly hard. Can the drugs on the left grow big enough fast enough to replace the ones on the right before they all decay to nothing? It is a massive, high-pressure gamble. So let's be absolutely clear about the mountain that management has to climb here. This isn't just one problem. It's a war on 4 different fronts, all at the same time. This is the heavy lifting. First, they have to somehow plug that $2.5 billion hole in the revenue ship just to stop from sinking. Second, they have to find new growth to make up for Lejavrio disappearing and Gardasil weakening. Third, they have to execute perfectly to turn their new drugs into giant blockbusters. And fourth, as if that's not enough, they have to successfully manage the launch of an entire pipeline of over 20 new drugs in the next few years. This is an incredible high-wire act, and there is zero, I mean zero, room for error on any of these fronts.
Exactly.
And all that heavy lifting, all that high wire walking, it costs a fortune, an absolute fortune. So now we get to the really critical question. Can their balance sheet actually handle this? Can they afford this massive company-wide transition? It's one thing to have a great plan, but it's another thing entirely to be able to pay for it, especially when your core revenue is under attack. So let's peel back the curtain and really stress test the money behind this whole strategy.
Okay, now look at this table. This is where the rubber meets the road. This shows you how Merck spent its cash in the last quarter. The biggest number on here, by a mile, is business development, $10.6 billion. That's the money they used to go out and buy those companies we talked about. Now the bulls will point to this and say, see, proof. They're taking their Keytruda profits and plowing them right back into the future. But the skeptic has to ask, can they keep spending money like this? They're also paying out $2 billion in dividends, buying back stock, and spending another $3 billion on R&D. Can they afford all of this when that $2.5 billion revenue hole opens up next year? The pressure on their finances is immense.
And this right here, this proves that management knows they're in a tough spot. They have announced a $3 billion cost-cutting plan. Let's be real, you don't slash $3 billion in spending if everything is going great. This is a purely defensive move. It's a flashing red light from the C-suite telling you they see the storm coming and they are battening down the hatches. They are desperately trying to free up cash to pay for this transition because they know their existing cash flow is about to take a major hit. This isn't a sign of strength, it's a sign that they're getting ready for a brutal, bloody fight.
And look, it's not just us seeing this. This quote from AI Invest really nails it. The market got all excited about the Q4 beat, but that's old news. The real story is the future. And as this analyst says, those headwinds are probably not fully baked into the stock price yet. Remember, the stock has already run up over 30% in just a few months. The danger is that investors have already celebrated the good news from the past without properly accounting for the very painful, very real challenges that management is literally screaming at them about for the future.
Okay, we've built the bull case for a solid foundation. We have hammered on the bear case and all the dangerous cracks that are starting to show. We've looked at the high-stakes race between the pipeline and the patent cliff, and we've put the financials under the microscope. So now, it's time to put it all on the scales and deliver the final iron financial verdict. Is this a golden opportunity created by short-term panic, or is it a classic value trap waiting to snare investors who are ignoring some very clear warning signs?
So let's boil this entire complex debate down to one slide. The bull case rests on the undeniable fortress-like dominance of Keytruda. It's about their aggressive strategy to build the next generation of drugs and the rock-solid stability from their animal health division. But the bear case is just as powerful. It's based on a massive $2.5 billion headwind that we know is coming, a crystal-clear warning from management with their weak guidance, the decay of multiple older drugs all at once, and the simple fact that the stock is already up 32%. All the good news might already be in the price, but the bad news? Probably not.
So we are going to leave you with the one question that every single investor needs to answer for themselves before they touch this stock. When you look at Merck, do you see a powerful giant using its incredible resources to forge its next decade of dominance? Or do you see a company frantically trying to patch holes in a crumbling foundation, just as the hurricane sirens begin to wail? Here at Iron Financial, we believe the best investments are built on clarity. And right now, the future for Merck is anything but clear. The risks are real, the numbers are daunting, and the road ahead is going to be incredibly tough. Whether that challenge creates a once-in-a-generation opportunity or a devastating trap, well, that's the question you have to answer for your portfolio. Tread carefully.